A bond trader is staring at a screen right now. 5.07. Not budging. The number is wrong by every Wall Street model on every desk in Lower Manhattan. Except, it is not wrong. It is the bond market casting a vote nobody on equity desks wanted counted. The 30-year Treasury just cracked 5% for the first time since the financial crisis era. And every model that priced 3 Fed cuts by December was just told very quietly, very expensively, that the long end has already voted no. Stay with me. If you carry a 401k, a mortgage refinance window, or a retirement equity allocation, this is the Contrarian data breakdown of what the long end just published. Subscribe. 3 primary sources, both sides on the table. This is educational. Mispriced Geopolitics is not a financial advisor. Now here is the data. Wall Street says 3 cuts by December. The Fed funds futures still price it. CME FedWatch shows a 64% probability of 3 cuts by the December meeting as of yesterday's close. But the data shows what neither the strategists nor the rate sellers are admitting. Tudor Jones went on CNBC's Squawk Box on May 7th and said it directly, quote, "There is no chance Warsh will be able to get the Fed to cut rates," unquote. Then he added the part the desks did not want broadcast. He would be thinking about raising them. This is not a hedge fund manager talking his book. This is a 50-year veteran who called the '87 crash and the '98 ruble crisis. The question nobody is pricing is what the long end already decided about Kevin Warsh before he has even taken the chair. On May 4th, the 30-year Treasury yield closed at 5.07%. That is the highest closing print since 2007. The Treasury said the auction came in soft. Indirect bidders, the foreign central banks and large institutional buyers who normally absorb the long end, took down only 58% of the issuance. The historical average is 67%. Reuters said demand was the weakest in 18 months. The bid-to-cover ratio came in at 2.07, which is the lowest reading since the November 2024 refunding. And it happened on the same day Iran sanctions started rippling through global oil insurance markets. The bond market did not blink. It accelerated. By Friday close, the yield had ticked another 4 basis points higher. Stay with me. What comes next is the part neither side wants priced in. Subscribe so you don't miss it. Because the gap between what the futures market is pricing and what the long end has already decided is the largest mispricing in the rates complex this year. And the long end has the receipts. Every chart we are about to walk through comes from the same Treasury auction tape every primary dealer in New York is reading. The difference is that the equity desks are still pretending it doesn't say what it says. Here are the 2 readings side by side. CME Fed funds futures are pricing 3 25 basis point cuts by the December 2026 meeting. The 30-year Treasury just printed its highest yield in 19 years. Both cannot be right. One of these markets is about to be repriced, and history says it is not the long end. The long end has been right at every major Fed inflection point since the Greenspan era began in 1987. It led the easing in 2007 before the Fed admitted what was happening. It led the tightening in 2022 before Powell said the word transitory was retired. The long end is not a forecasting model. It is $12 trillion of capital making a positioned bet. The futures market is leveraged speculation by definition. When they disagree this much, you don't bet on the speculators. There is one historical parallel that fits this setup precisely. October 1979. Paul Volcker takes the Fed chair. The market expected him to ease into the role. The long bond yield was at 9.5%. Within 15 months, the long bond cracked 14%. Volcker did not cut, he raised. He raised the Fed funds rate from 11% to 20% in a span the bond desks of that era still talk about as the most violent repricing in post-war history. The S&P fell 27% before it bottomed in August 1982. Today, the setup rhymes in 3 specific ways. Warsh is the incoming hawk. The 30-year is signaling the same thing the long bond signaled to Volcker in '79, and the equity multiple is sitting at 22 times forward earnings, almost identical to the multiple the S&P carried into the '79 repricing. The market is not asking Warsh for permission to reprice. It is repricing already. If the long end is right and the futures market is wrong, 3 things break in sequence. First, mortgage rates reset higher even without a Fed move, because the 30-year mortgage tracks the 10 and 30-year Treasury yield, not the Fed funds rate. Bank rate already shows the 30-year fixed mortgage at 7.4% and rising. If you carry a refinance window into 2026, that just got harder to call peak.
Second, investment-grade corporate spreads widen by 80 to 100 basis points as credit gets repriced against a higher risk-free rate. The IG corporate spread is currently at 104 basis points over Treasuries. The historical average when long-end yields cross 5% is closer to 190. If you hold investment-grade bond funds in your 401k, the Vanguard Intermediate, the iShares LQD, the bond sleeve in your target date fund, that is a markdown your December statement has not caught yet. Third, the equity multiple that priced 3 cuts at 22 times forward earnings collapses towards 18. If your retirement account runs 60% equity, that is the re-rate the bond market just told you mathematically to price in. That is not a forecast, that is the math the bond market just published. There is a second force pushing the long end higher, and Wall Street is not naming it. Reuters reported on April 22nd that war-related inflation pressures from the Iran sanctions are pushing the next Fed cut into late 2026. The bond market read that wire, the futures market did not. Quote from the Reuters poll of 54 economists, inflation pressures linked to the Iran conflict have pushed the timing of the next Fed cut deeper into late 2026, unquote. The long end is pricing duration risk on a multi-quarter inflation persistent story. The futures market is pricing wishes built on a base case from January that no longer matches the data on the ground in May. When two markets disagree, the larger and less leveraged one is usually the one telling the truth. If you have made it this far, you are exactly the kind of viewer this channel is built for. Subscribe. 3 primary sources, both sides on the table, 0 hot takes. The stakes clock is ticking. The next 30-year Treasury auction is May 22nd. That is 12 days from this video going live. If indirect demand comes in soft again, the long end will print another leg higher and the divergence with the futures curve gets violent. The April refunding announcement from Treasury already telegraphed a larger coupon issuance schedule for the third quarter. More supply meeting weaker demand is the textbook definition of a price decline, and the equity market still pricing 3 cuts will get its first real test before Memorial Day weekend. A bond trader is still staring at the same screen, 5.07. The futures market has not budged from 3 cuts. The bond market has not budged from its veto. One of them is about to be repriced violently, and the gap between them is the trade most desks are too leveraged or too late to put on. Now you understand why the long end vetoed Warsh before he even took the chair. Subscribe, and turn on the bell for notifications so you don't miss the next breakdown.